Let's bring in David Nicholas, take a look at the market and these bank earnings. David joins me right now. What do these bank earnings tell you about the economy and the market outlook?
Yeah, I mean, Goldman Sachs has posted, this is a big loss for Goldman. I mean, this is huge. I mean, investment banking activity is down. That's not a sign of a growing economy. And if that's a theme, Stuart, if you look at JP Morgan and Citi that reported last week, their investment banking revenue was down 60% for the quarter. So again, banks are not creating new economic activity. But the positive note, though, is if you look at some of the money center banks like JP Morgan, Bank of America that do more normal lending, they are doing well. They're beating profit expectations because interest rates are rising, and that's impacting the bottom line for financials. So I think it still spells that things are good for the economy, but we're not going to see the type of explosive growth because we're just not seeing investment banking activity. So that's where I see some concern for the overall economy, Stuart.
Can you tell me the name of the stocks which are winning, they're going up, but they're still cheap in terms of valuation, your price to earnings relationship? I see we've got a list here. I see Costco on that list. Cheap and still going up. Is that what you're saying?
So, Stuart, there's a lot of uncertainty for this year. I'm excited for this year because this is a stock picker's market. I think you can do well if you know the right names. Let's take LYB.
I'm sorry, it's Cisco. I'm sorry, I made a mistake.
Cisco, that's
okay,
right. I do
going.
like Costco, but Cisco. Well, we'll start with Cisco then. Look, this is a technology name, but what I like about it, Stuart, is trading at 13 times forward earning. They have almost a monopoly in the networking side, and they just raised their earnings per share guidance for 2023. In a year where companies are lowering guidance or not giving guidance, they're raising guidance. Also, let's take LYB, Lyndon Bassel. You guys were just talking about China opening up. This is a materials and chemical companies. Their product is almost in every product that we use. They're paying a 5% dividend. You're going to love this. Trading at 11 times forward, so well below the market. Since we're talking financials, I'll give you one more from a different sector. PNC, they report this week, paying a 3% dividend, but I think they are more defensive because they are regional. They don't have exposure like JP Morgan, Morgan Stanley, Goldman Sachs to global events. So I think regionals are going to win in this environment, Stuart.
All right, I like that 5% dividend from Lionel. I'll take that. Thanks very much, David. We'll see you again soon.
Well, if you're right on that, the run-up we had in the first half of January, right? I mean, which had some people saying if you believe in the January effect or the January indicator, it bodes well for the rest of the year. Not that every day can be a buy day, but how do you see this year sorting out? Again, armed with this latest data and your opinion, you've been very accurate on the Fed. So I'm just curious if they maintain the position you said, that's going to be some headwinds for people who thought the headwind days were over.
That's right. And it's all about alternatives. As investors, when we're advising our clients, we're looking at all asset classes and we're looking at our risk reward, right? When you look at equities, what is the risk reward? You take a lot of risk for what will probably be a lower reward this year. This is why we see bonds as a much more promising asset class. I know, Neal, this will put us to sleep. We talked about bonds yielding 4.5%. But in an environment where we're probably not going to see any move higher for the market this year, would we rather own 4.5% in a treasury, or would we rather sit in stocks and growth stocks that probably aren't going anywhere? And this is where I think a lot of investors are making that very same decision of reallocating more to fixed income. I think that puts another set of pressures on the market this year, that stocks are going to have to prove themselves. This is the year for public companies proving why investors should own their stocks over more dividend-paying or fixed income securities, Neal. So the market, it's got its challenges ahead of it, but we also see that the silver lining is these other asset classes like bonds, I think, are going to shine in a year like this, Neal.
We shall see. David, thank you very, very much. I had you scheduled for other things, but you flawlessly handled all of these late-breaking developments as well. Always appreciate that, David. You're the Federal Reserve. We just learned, unfortunately, Jerome Powell is dealing with COVID. Don't know how that will affect what he has to do. It's a mild case. We hope it stays a mild case. But you know the drill here. They're going to be meeting, in what, a couple of weeks. The expectation is they're going to raise rates at least one more time, another quarter point, could be more, but maybe in this environment not. What are you predicting?
I think it really, comes in. Where's inflation going to end up? Obviously, we're seeing inflation come down, but I think the Fed has been pretty clear. I just laugh when I see this talk about rates being cut by the end of this year. Neal, we're not going to be in a rate cutting environment, in my opinion, in 2023. So I think rates are going to be stable. I still think we'll end up around 5.5% for the Fed funds rate. So there's still some juice left in rate hikes, but we're slowing, right? We're not seeing 75 basis points. Probably not going to see 50 basis points. Probably going to see 25 basis point hikes over the next few meetings. We're going to level off, but I think what the market's maybe not pricing in is that we're going to stay at that 5 to 5.5% level. Could be for 6 to 9 months or even 12 months and beyond. And that's where I think the market is getting it wrong. They're seeing this yield curve drop at the later part of this year. I don't think we see it, Neal. And obviously that's going to put pressure on lending, on credit. It's going to slow growth continuing into next year. So the market is getting a little bit ahead of itself from the rate standpoint. I think the Feds are going to maintain really a more hawkish policy for much longer than the market expects.